Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins on a rather kind of bad day in the markets, both bonds and stocks. The market has been working its way down all day, and when the Fed Open Market Committee announced its decision on how it was going to deal with QE2, that they were going to continue but began to tapering probably towards the end of this year, and anticipated being out of the QE business by the end of the fourth quarter of 2014. Now that's almost 6 quarters from now. They released their forecast and they believe that by the fourth quarter of 2014, unemployment will in fact be at the target level they were looking for of 6.5%, which has been, if you followed the Fed, the target at which Bernanke said that he would probably stop quantitative easing when unemployment got to 6.5%. Now, we had an unusual day in both the stock and the bond market sold off sharply. And what's important is that the stock market sold off all afternoon and literally closed on its low for the day. Normally speaking, when an equity market sells off and closes at the low of the day, the next morning would see a continuation, perhaps even a sharp drop, and we will find out probably by 10:30, 11 o'clock tomorrow morning whether this is the beginning of a correction that we've been talking about, looking for, or was it going to take us down about 4% and then turn around and go back up again. So I would expect to see in the first hour or so tomorrow morning a decline of at least 100 to 150 points, taking us below the 15,000 level on the Dow. And then if we are truly in a long-term bull market, I would expect to see the market to try and stabilize and maybe try and close up marginally for the day tomorrow. If on the other hand we continue to see this selling pressure, this panic if you would, that people are concerned that rates are going to explode higher and as a result equities become less attractive, we could see a continuing of selling pressure. It could build some momentum, which could be negative for the market, at least near term. We have been talking about with you for some period of time the importance of having some downside protection. I can't protect 100% of the portfolio. The only way to do that is be 100% in cash and you wouldn't be earning anything. But we use the TBT, which is the Treasury, 20-year Treasury short-term short position, and also for the equity markets we use the SDS, which is the S&P 500 short position. Both of those performed dramatically well today, and it showed that with the market off 1.5 to 1.6%, our portfolios were probably off about half of that much. The reason being that the TBT and the SDS took some of the sting out of the market. So if I'm right in the morning, we should see a continued move upward in interest rates and bonds, and we see a decline in the stock market. Those will continue to participate. If we are in fact in the beginning of a significant correction that could take us down 10% or more, then the SDS position that we have will serve us extremely well. We're in a very difficult time trying to figure out which way this economy is going to go, which way the Fed's going to go. And I think a lot of it is dependent on earnings momentum as we get into the second half of the year. Do people believe that earnings are growing or earnings contracting? And that could put more and more pressure on the significant gains that many portfolios, including ours, have seen over the first 5 to 6 months of the year. So it's going to be a rocky road, and I thought it was important to get to you as soon as possible. As always, should you have questions, please feel free to give me a call or send me an email. And if you have friends or relatives who are looking for somebody to help them, please feel free to give them my name and number. Thanks for watching, and this is Dan Perkins.